Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to the Daybreak Asia podcast. I'm Doug Krisner. In the States, the House of Representatives passed a Senate measure to end the government shutdown. The president signed it, and the government will resume operations on Thursday. In a moment, we'll look at U.S. markets with Mike Dickson of Horizon Investments. We begin, though, in Hong Kong, where we had the chance to catch up with Yifan Hu, Chief Investment Officer and Head of APAC Macroeconomics at UBS Wealth Management. She spoke with Bloomberg TV host Yvonne and Annabelle Droulers. Now, the conversation began with a question on the outlook for the Chinese economy.
Let's talk about 2026. I mean, I feel like the year has just sort of flown by and we're already forecasting. So what are you talking with clients about right now?
Yeah, I think that's the most interesting question now. I think that for 2025, if we see the China's GDP growth, we think we will end up with 4.9% to 5%. So for the next year, we think the government could set up the target between 4.5% to 5%. So in our view, if without a major stimulus, so the GDP could reach around 4.5%. So we will have probably lower for the first half, the high for the second half.
How significant would that be? Lowering at least that range when it comes to that growth target for next year?
I think this year is around 5%.
Yeah.
So I think that if it's end up with 4.9%, so it's also hit the target. So it's possible for them to give a range rather than say around 5% again. So because the next year could be lower unless the government wants to put the major stimulus. But we think the chance is not very high. So I think they would rather put a range, maybe more comfortable for everyone.
So not major stimulus. That's more of the fiscal side. What about the monetary policy side?
Monetary policy side, I think we'll still keep easing and keep accommodative, and we still expect 50 to 100 bips of the cut by the end of the 2026, and also maybe 20 to 30 bips of the interest rate cuts, because given our CPI inflation is still pretty low.
What are you expecting to be kind of the bigger drags next year? Is it the export side of things is going to be a bit softer than this year? That has been quite resilient. And are we just not expecting any sort of meaningful recovery in the consumer?
For the consumer side, I think we think it still will be between 3 to 5%. We didn't see too much highlights about that. I think but the major driver should be still for the industrial output side. Industrial product, because AI-driven applications, and also with this kind of advanced manufacturing, and possibly we call the new productivity growth. So I think that will probably lead in the driver. On the other side, for the energy side, I think that especially this year we see for the energy reserves, a new energy, and also for this kind of the high voltage electricity transmission, that's all could become new highlights. But for the consumption side, I think it will be, in my view, I could call it stable, but will not be very strong. Property will still be the drag, but we don't think the government will put too much efforts on that. So we'll just let it go unless it's have the cliff the drop, but that's the chance also small.
Picking up on that theme around increasing automation you were just referencing there, how does that also impact the jobs outlook and the employment outlook as well?
In this sense, I think for the AI application, so one side, of course, more jobs may be taken by the machine, but at the same time, we think maybe service sectors still have the chances, and also with a new AI applied services sectors, maybe there's some more we call the experience exposure a services sector come out that's more digitized, and also with this kind of more entertaining, or even with more creative, more service-oriented, job opportunities. But still, I think there is still a pressure.
And you guys upgraded Chinese tech just a few weeks ago and saying it's probably the most preferred, right? Most attractive here right now. How are you looking at this rally around AI and the like now, and how do you position around it for next year?
I think for this year, AI already rallied for 2 years, like last year, this year, especially for this year, almost over 30%. But I think think about it, for all this kind of big platforms, very similar to the US, like Magnificent Seven, I think they just started. Because like one side, I think their valuation is still relatively low, like 30% of discount comparing with the US peers. And the second, I think for the China, the AI investment is still like a capex is still increasing, like similar to the US. And also third, I think it's a little bit different from like the US side. I think the China is more like an ecosystem. So I think that with this kind of ecosystem, with the basic research, like then the AI application with this ecosystem could like the spillover effect. We think it could be bigger.
One of the sort of issues, I guess, around the AI application side is sometimes low barriers to entry. What are the sectors that you look at in terms of that AI theme in particular as being a bit more resilient, I guess?
I think the AI theme will range you from the low end to the high end. So if we can like AI applied like advanced manufacturing and new materials and also healthcare, I think it's booming because of the AI like the application. And then we also could see AI applied to maybe like aerospace and also some like many like new fields. I think just like speed up the exploration and also like innovation.
What are some of the key themes you're watching out? I mean, for the fourth quarter, because I think there's been a lot of allocation into domestic tech already, especially you take a look at how institutional investors are kind of positioning. Do you think that this is extreme levels when you talk about fund concentration now? And you know, we've already started to see some rotation out of tech. Can that continue in the fourth quarter?
Yes, I think that it started with the tech, and also like the concentration with tech. We think the tech still have the loom, but we also see it's applied to other sectors as well, like gradually. For example, we think that this year it's also very shiny sector is for the energy reserves, because by now for the new energy already supply 35% of the China's like a total energy supply. So I think that's like a very like significant number, and we also see like maybe the healthcare will benefit because their price has been low and could benefit like maybe with this kind of application. And for the consumption side, that side is we have the new consumption, but too high, and it's not easy. But I think that we still have this kind of the new materials, and we also see for the sector like booming out, and also the AI is not only the software and also have the hardwares, but of course most sectors, most companies are in the A listed, so that's the reason we also think the A shares and could also could slightly better perform than H share next year because with all this kind of the like hardwares.
So that's the equity side. What about the fixed income side? What are your preferences there?
For the fixed income side, because we still expect like for the interest rate will go down. So I think for the bond side, I think it's not very attractive, but the existing bond, of course, like I think I still like have the gain.
The PBOC is buying bonds again, right?
Yeah, that's true.
Is that likely to be more measured this time around?
I think PBOC, and also I think the PBOC also. I think that this year we also see for the companies actually issue like Chinese for the CNY bonds like in Hong Kong. Yeah. So I think the government like PBOC buy bonds. I think it's more like keep the monetary. They call it. They don't call it quantitative easing, but I think it's more like provide the liquidity adjustment of the liquidity provision in the market.
That was Yifan Hu from UBS Wealth Management speaking with Bloomberg TV host Yvonne Mann and Annabelle Droulers on the Daybreak Asia podcast. Welcome back to the Daybreak Asia podcast. I'm Doug Krisner. As mentioned earlier, the House of Representatives passed a Senate measure to end the longest government shutdown in U.S. history. Now, in anticipation of this development, the Dow climbed for a fourth straight day, breaking above 48,000 for the first time and closing at a record high. Financials led the way. For a closer look, I'm joined by Mike Dickson. He is head of Research and Quantitative Strategies at Horizon Investments. Mike, thank you for making time to chat with me. If you don't mind, I'd like to start with Cisco Systems. We heard from the company after the bell, an upbeat sales forecast, which is likely a reflection of the progress Cisco is making in capturing more spending on AI. The stock was up 8% in late U.S. trading to around $80. Now, that is the closest Cisco shares have come to 82, their all-time high set back on March 27th, 2000, right as the dot-com bubble burst. It's interesting timing, maybe, with all the talk we've heard about bubbles.
I certainly love the history throwback, and yeah, I mean we are right on the cusp of reclaiming that high. I would say, at least on a dividend-adjusted basis, that has been reclaimed within the past several months. But nonetheless, look, this AI trade is not the internet bubble of the '90s. When we look at the underlying fundamentals at the top of the market, you have had extremely strong earnings growth and revenue growth, and this earnings season is no exception. When you look at the Magnificent Seven and the NASDAQ, you've actually had an inflection higher in revenue growth year over year of 15% for the NASDAQ, and that's up from 10% about a year ago. So we've had an inflection higher in revenue growth. Obviously, earnings have been absolutely stellar. We have seen cash flows come down a good bit because of a lot of the CapEx, but we are seeing significant plans to make the power demand and the deals needed to get that infrastructure built and make that stuff happen. So really strong fundamentals here supporting the top of the market, which is not what we had back in the late 90s.
Even so, over the last couple of days, we've seen a rotation away from big cap tech. Yesterday, that would be the Tuesday session in the States. It was healthcare. Today, it was the financials. Is it prudent now to kind of maybe take a little bit of risk off the table?
Well, we have seen a little bit of rotation, but I think the market overall, we tend to forget that some of these stocks actually can be flat for a day, and that's completely normal. And in fact, it's very healthy. Zooming out, when you look at the more equal weight version of the S&P, or I believe that the Dow crossed over 48,000 today. That of course does not have a lot of the Mag 7 top of the tech and AI trade really embedded in there. It's healthy to see some of that, certainly with what we've had this year, because market concentration has been growing, and it is good to see a broader participation, even some of the defensives. You mentioned healthcare. I mean, that to me is a really good kind of contrarian sector play, and I think it's good to see participation there. We've had a stellar rally in the top of the market, and I do believe right now it might be prudent to think of that as more of a hold and not necessarily an add. We do have NVIDIA next week, which is a macro event in and of itself, so we're going to need to see what that holds and whether this Santa Claus rally is going to be what we get through the end of the year. But there are other opportunities other than AI out there, and I do think it's wise to be looking at what some of those may be.
Earlier today, the White House said that the October reports on unemployment and consumer prices will unlikely be released. Obviously, these numbers have been delayed by the shutdown. This is only going to add to a little bit more of the difficulty in gauging the outlook, especially for the Fed. Right now, I think Fed Fund futures suggest a 63% chance of a rate cut next month of 25 basis points, although we're hearing more and more from a number of Fed members about the concern over inflation, it being sticky, and perhaps a bigger risk than the unemployment story. Where do you come down when it comes to the Fed and the outlook?
Well, seeing that the headline today about the delay in those reports is not great timing, right? I think we are at a point where we have had a pretty steady decline in labor market data heading into the shutdown, but at the same time, inflation it hasn't necessarily been a problem, but it hasn't been improving at the rate that folks would like. And so, what has happened with this shutdown is a lot of these surveys just didn't get completed, and as a result may not be, for at least what I was reading, the first time ever. That's not great because the December meeting as well is a little bit earlier this year than it typically is. And so we're going to be kind of running up against the wire to get a lot of this data collected and get a fresh view on the market. But, overall, I do think what we saw at the end of October was a little bit of a surprise from Powell and the committee as a whole. He mentioned a number of times that the December cut was not a foregone conclusion. For me, and I think the rest of the market, that was a good bit of a surprise to hear that. On the inflation side of things, though, and I hear the arguments out there, but if we also zoom out a little bit, the Fed has been above their inflation target for the better part of nearly 5 years. And in their recent statement of economic projections, they don't have us getting back down to 2% until the end of 2027. I mean, look, that's almost 8 years that they're going to be spending above a 2%. And to me, I'm not so sure their target practically is 2%. And so we'll see what the committee thinks here in December. But I for one, do believe that in the mid-twos, they're probably perfectly comfortable with that, so long as they get stability in the labor market. So that's the side I'm on. I think we're going to get a cut, but we're going to have to see. It's going to be highly dependent on what the missing information tells us.
So I'd like to get your take on whether or not there is a great degree of bifurcation in the economy. It was very interesting today. We heard from Fitch Ratings, and the company said the share of some prime borrowers, at least 60 days past due on their auto loans, rose by more than 6% in the month of October. I think we're now at the highest level since about 1994. Now, you and I both know what the wealth effect has done, this move higher in the equity market, and how higher income earners that own stocks have been able to power a lot of consumer spending. Maybe there's a little bit more concern about lower and middle income households. Do you think this has the potential really to hold back a lot of growth, the way in which we're kind of divided?
I don't think we're really there yet. I think that the economy, as we're seeing in the stock market, has become more concentrated because not everybody is, participating in a lot of the equity market wealth that has been created. But, you mentioned on the debt side of things, the New York Fed puts out their quarterly debt and credit report that comes out. It was just last week for the third quarter, reporting on a lot of these statistics, across loan types and across the different age and other demographic areas. And, we really didn't see many headlines around that in Bloomberg or otherwise. And the reason is because nothing really got that worse or alarming. And I hear you on that data point on the auto loans, but, it didn't really show up in a screaming manner on a change basis, in that major quarterly report. So, I don't think that I think that was good that we didn't see that tick up there. But I don't think we're quite at a trouble area yet, as it relates to that. And overall, the consumer is in a really, really healthy pace. And we've seen that when we used to get economic data. We saw that broadly. And we'll hope to see that again here once the floodgates open back up and we get some information.
Even so, if you look at the results of the election last week, we're talking New Jersey, we're talking Virginia, even here in New York City, this issue of affordability, it's front and center.
It is. I think one thing on affordability that's going to be an underappreciated boost to economic activity is really on the housing side, and I think you can see that through the fall in mortgage rates. We are still in the low sixes, but a good bit down from where things were. And one of the metrics that we look at and have been tracking closely is interest rate volatility and how that's been falling. And that's playing a pretty big role in where mortgage rates are relative to the 10-year. And, as we get closer and closer to the end of this Fed easing cycle, we're going to continue to see that interest rate volatility fall. And even without a change in the 10-year, mortgage rates can still come down. I think some estimates that we're looking at, we could see, in the 5.5 range with no change in the 10-year, just simply through this volatility reduction channel with interest rates. This is going to be a really big boost to just housing affordability overall, because the activity has been just completely on the floor there. And I think that can be a really big boom when it comes to consumer confidence, labor mobility, home equity lines of credit. There's a lot of, I think, booming economic activity we can get through that mortgage channel. And I think that is something that's a little bit underappreciated, but things have been moving in the right direction to make at least the housing side there with existing homes, a lot more affordable. And as time passes, I think that's going to be alleviated a little bit through that channel. And that's a really good thing.
So, Mike, where are you finding opportunity domestically?
Well, one of my favorite areas right now, I'll give two things that really have my attention lately. One of them is the small and mid cap space in U.S. markets. Now, this has been a trade that has had its fits and starts, right? You've seen numerous very short-lived kind of rallies in the smaller cap segments of the market, but it's really failed to sustain a rally, in the last several years. And I think there's a couple things working in favor of that trade right now for more of a longer term hold. One of them is this rate channel, right? The high level of rates overall have been, difficult and weighing in a disproportionate manner on the small and mid cap space, right? Microsoft, Nvidia, these folks don't really care too much about the level of interest rates. They have plenty of cash flow and balance sheet. So the fact that rate hikes are definitely off the table, and whether we get a cut in December is one thing, but the direction of travel is down. That's a really good thing for small caps overall. The second thing I'll point out too is we've seen earnings breadth really pick up materially in that space. You saw it this quarter with earnings for the S&P 600 coming in about 12% year over year. That's the same as we got in the S&P 500. You also saw a pretty solid near 10% earnings per share surprise, so just beats with the S&P 600, the smaller cap names. That's the second quarter in a row where it was, a stellar beat. And most importantly, valuations have actually come down on a forward-looking basis for small cap stocks. So you've got really a good entry point there. They have not participated with the top of the market rally. And then on the longer term view, just, overall domestic focused policies, deregulation, potentially M&A activity picking up, I think is a really good entry point. And I'll add a really good seasonality kind of time of year to kind of enter that trade and carry that in your portfolio through 26. So that's one area I really like. And then healthcare as well is a kind of a sector contrarian play I like for similar reasons, in the sense that healthcare used to be a kind of crowded secular growth trade. It's now very firmly on the value side of the market, with lower valuations only in energy and financials. And you still see really strong strength on the top lines there. And it also hasn't rallied. I think that's poised to be a winner as we head into next year, too.
I'm curious about how you're feeling about markets outside the U.S., particularly in Asia. Any interest there? Maybe Japan?
Yeah, overall, I think international diversification in general is a great place to be. Certainly, with hindsight this year, right, international markets have done exceptionally well. But, one of the things that I think is not just think, I firmly believe is going to be critical for, this AI trade and the AI CapEx to really be put to work is, just the infrastructure being built out. And when you look at the international bloc, you have a sector composition that's primarily made up more so of industrials and energy materials type companies. These sectors, not only are they underrepresented in the U.S. economy, they're also poised to participate in a kind of industrial type rally and industrial type build out. And I think that's going to be a really good sector composition to look to as a diversification from the tech centered U.S. markets, but also as you get a lot of that infrastructure build out. And then, of course, there's also the policy side of things from a central bank perspective. I think with the Fed, still in the cutting cycle where a lot of other, global markets are kind of near the end of theirs, you're going to continue to see this kind of narrowing interest rate differential. That should weigh on the dollar more, and that should be a tailwind for those kind of foreign markets here in U.S. dollars. So, a couple reasons there. I think the just international block as a whole is kind of a great place to be and provide some diversification from the U.S.
Very quickly, Mike, do you want to be exposed to China right now?
I think China does have some interesting prospects to it along those similar lines, most acutely just from just a policy response standpoint. So yeah, I think China is going to be critical to a lot of this kind of cyclical build out theme that I'm talking about. So yes, I think that would be a good emerging market area of focus in the international block.
Okay, Mike, we'll leave it there. Thank you so very much. Mike Dickson there. He is head of research and quantitative strategies at Horizon Investments, joining us here on the Daybreak Asia podcast. Thanks for listening to today's episode of the Bloomberg Daybreak Asia Edition podcast. Each weekday, we look at the stories shaping markets, finance, and geopolitics in the Asia Pacific. You can find us on Apple, Spotify, the Bloomberg Podcast YouTube channel, or anywhere else you listen. Join us again tomorrow for insight on the market moves from Hong Kong to Singapore and Australia. I'm Doug Krisner, and this is Bloomberg.